Hello, everyone. Welcome back to another episode of The Week in Charts. I'm Charlie Bilello, and with me today, special guest back on again, Jamie Battmer, Chief Investment Officer at Creative Planning. Jamie, welcome back to The Week in Charts.
Hey, Charlie. Thanks for having me. Hopefully your summer wrapped up fantastically.
Definitely sad to see the summer go, as always, but it has to end, and here we go. The Week in Charts is here. If you're not subscribed to the channel, subscribe to our YouTube channel. Exciting news, Jamie. We just passed 30,000 subscribers, so thanks everyone for subscribing. Hit that subscribe button for all the latest content from us. And if you're looking for a second look on your portfolio, your financial plan, you want to talk to experts like Jamie, fill out this form at creativeplanning.com/Charlie. Get a free wealth path analysis at Creative Planning. We're in all 50 states, so we likely have a location right near you. Over $370 billion in assets under management and advisement, and we're here to help. So reach out today, creativeplanning.com/Charlie. Jamie, we got a lot to talk about today. Death, taxes, I'm going to add one more here, and printing money. Easing is the opiate of the markets. The AI revolution, what inning are we in? That's a question a lot of people are asking. Tariff rebates, is this a good idea? It's starting to be floated around a little bit here. Is AI coming for our jobs? Probably the biggest fear about AI. We're going to discuss that. We'll end with something positive, as we always do. Less work and more prosperity. We'll run through some charts that illustrate that. Okay, Jamie, here we go. Death, taxes, and printing money. So there's that famous saying, the only certainties in life are death and taxes. I'm adding one more, and that's the money printer. And the money printer was paused for a little bit in 2022 after we had that record surge in the money supply. You could see on the chart here, unprecedented, 26.7% year over year. We actually printed 40% more over a 2-year period. We never saw that in history. Then we pulled back for a brief moment in time, but here we go again, up 4.8% over the past year. That's the highest we've seen in terms of the growth rate in 3 years. And look, here we are now, Jamie, back at all-time highs in terms of the money supply. And that seems to be the one constant over time that you can count on is we're going to print money. The only question is how much. Why do you think, Jamie, before I dig into in terms of what's the impact of the increase in the money supply, why do you think when we were watching the Federal Reserve, we're watching those press conferences at every meeting, we got another one coming up in a few meetings. Why do you think this is something that's never talked about? It's literally like they must tell people, they tell the reporters, don't ask about the money supply. Nothing in his speeches ever mentions that it even exists. It's pretty much anything else other than the money supply you can ask about. Why do you think that's the case when we know how important it is?
Both sides, all sides benefit from it as just a quick fix, right? It just, a problem manifests itself, stimulate. A perceived massive downturn comes, some kind of increase in the money supply. Really kind of that quick fix, which feels good. It smooths out the edges, but like any of these elements, any kind of medicine or opiate, whatever that helps you in the short run, it's oftentimes terrible and worse than the actual disease or ailment over the long run. And so it's a real concern. Again, it's really interesting. Neither side is really wanting to highlight it, it seems like, because they're all benefiting from it under their own particular time period of control. And so, yes, it is a concern. The one thing too, though, Charlie, is this is a problem, but this is not a uniquely American problem, right? We just are the dominant global economy, and so the numbers we work with are very, very high. But it is not as if this isn't an exercise that's being undertaken across the globe. And while you don't want to say, well, you're the cleanest dirty shirt in the hamper, this, again, is not a uniquely American phenomenon. Just the dollars that we see, the absolute amount added is extraordinarily awesome power that you can't see with any other economy.
Yeah, all true. But in terms of the Fed, how do they get the pass in terms of not being able to discuss this? Because as Milton Friedman once said, in terms of what produces inflation is very simple, according to Milton Friedman. Too much government spending and too much government creation of money and nothing else. And if we look at this chart here, you can see the last 20 years, a lot of money created, a lot of national debt added because we're running persistent deficits, as we'll talk about later. And you see the inflation going up 66%. But when it comes to talking about the causes of inflation, Jamie, they'll talk about oil shocks. They'll talk about supply chain issues. They'll talk about just about anything else other than these two factors, which seem to be fundamentally the biggest causes of inflation. So what gives? Is it just they don't want to recognize it because then it would be admitting they have some control over it? And obviously we know that's why the federal government doesn't recognize this as a cause of inflation, because they're contributing it to as well. It's as simple as that.
Yeah, I think you're on to something there, Charlie. I mean, usually the right answer is a simple answer, but it's just allowing the dancing to continue on the deck of the Titanic, right? Not to say we're about to hit an iceberg as an economy or anything like that, but it's allowing us in that unique. Again, this isn't a uniquely American phenomena. It's a uniquely American phenomena to be able to get away with it because we are just unequivocally the global economic alpha dog economy. It's again Europe not accelerating at the same speed we as China with all of its demographic issues. Obviously Russia deteriorating, India still dealing with having problems feeding their population, and so the fact that we have such a extraordinarily objective advantage, relatively speaking, against other economies, it would be nothing different than the stuff that the Romans could get away with 2,000 years ago, and you have these levers you can pull, and so the fact that it just allows that dance to continue to move forward, it's allowing us to take advantage of these levers that we can pull that others cannot, and so it keeps the music playing a little bit longer. But when the music stops, the rush for the exits, the rush for the lifeboats will be just that much more dramatic.
Yeah, no one could, of course, predict when that music's going to stop, but what seems to be the medicine is just more of the same, right? In terms of the next crisis, I'm not sure, Jamie, they're not going to throw money at it again. That would be my best bet of exactly what they're
It'd
going to
be
do.
shocking if they didn't do that, because why not keep going with a playbook that has seemingly worked, even though you might be mortgaging elements of the future, mortgaging elements of our kids, our unborn grandkids. But yeah, it would be shocking if they wouldn't automatically go back to that playbook.
So kicking the can down the road is the default. Why take the pain yourself when you can delay the pain? And speaking of that, let's talk about easing is the opiate of the markets, because it seems like, Jamie, pretty high probability bet we're going to return to that easing state in September. The Fed, as you know, has been on hold all year long, but after Jackson Hole, it seems like the market's pretty confident here based on the comments from Powell that they're going to resume cutting rates in September. Here's the odds here. Latest odds from the CME, 87% chance of a rate cut in September. And as we get closer to that September 17th meeting, these odds remain high. It seems pretty likely they're going to cut because, as we know, the Fed has never disappointed since 2009. They've done exactly what the markets expected them to do. And looking out further, Jamie, really they're expecting this benevolence, this dovish Fed to continue here. We know these odds can change dramatically, so you have to take it with a grain of salt for sure. But in terms of what the expectations are today, they're not expecting just a one-off in September. They're expecting another one before the end of the year, another 25 basis points. And then in 2026, they're expecting a few more. And they're expecting the Fed funds rate to go back below 3% by the end of 2026. And if we look at the markets objectively, they seem to love this. I mean, after Powell made those comments at Jackson Hole, markets across the board, pretty much every asset class spiked even higher. Of course, it was already doing well in the year. You had the S&P 500 this week crossing above 6,500 for the first time, the fifth 100-point milestone of the year. If we just look 5 years ago, Jamie, we're at 3,500. 10 years ago, we're at 2,100. Pretty incredible growth. 20th all-time high of the year so far this year. And as we say often about all-time highs, I'll just say it again. They're not a signal by themselves whatsoever. They're often followed by more all-time highs. But what do you make of this rising tide lifting all boats? The market's really loving, easing with every major asset class in the green so far, stocks, bonds, and everything in between.
Well, first off, take out the easy and take out the recent all-time highs. Just the markets over the long run go up more than they go down. If you're broadly diversified, if you're taking advantage of doing the right thing, the recent volatility we saw in April, by rebalancing, tax loss harvesting, an extraordinary amount of opportunities to add value without having to guess the market's direction or trajectory at all. Just knowing over the long run, not putting your eggs in too few baskets, it historically works out every single time. Now, trying to guess the markets, what you showed with the Federal Reserve expectations, let's juice up the flex capacitor and hop in the DeLorean, the time machine, Charlie. And let's just go back 1 year or 18 months or whatever it was, right? 2024, the beginning of it, those same people, they were projecting 9 rate declines. That was the assumption. Well, that of course didn't happen because it was prevalent upon market conditions. Market conditions didn't warrant it, and so the Federal Reserve, they're pretty good at saying what they're going to be doing in the next couple weeks. But you really get any farther out than that, their guesses are just as mediocre as any of our guesses. And the data is overwhelmingly supportive of that. And that's actually a good thing because first off, they're just human beings, even though it's a small subset of primarily academics that have extraordinary amount of power. But again, it needs to be dependent upon market conditions. And so don't fear all-time highs. Don't listen to, well, this is a top. This has to rotate around. Well, yeah, if you've got all your money in some very specific asset class, that's a consideration. But if you're broadly diversified, it's going to happen. But most so, don't listen to the guesses, the expectations, because the men and women who lead the Federal Reserve don't know any better than my 7-year-old as far as what interest rates are going to be 18 months, 2.5 years, 10 years from now.
I completely agree with that last point you made. And then the question, though, JB,
he's a smart 7-year-old, so that makes sense.
Yeah,
he takes after his mom.
I might even say he would make better decisions based on the Fed's
very much
recent history here.
But you can almost
let's talk about today's reading. Core PCE. This is known as the Fed's preferred measure of inflation. Moved up to 2.9%. Highest since February. Of course, what's their target inflation rate? 2% hasn't been achieved on any of the major metrics. And really, we only have one more inflation report, Jamie, before that FOMC meeting in September. One more big one would be the CPI report, and that's not expected to show a decline. It's actually expected to show an increase, I think, up to 2.8%. So you got one half of their mandate moving in the opposite direction. And as I've talked about, if you look at the cumulative inflation, you look at the last 5+ years here, we've more than doubled the Fed's 2% target. So what I've been arguing, and I'll say it once again, the Fed has no business cutting interest rates if their concern is about inflation. But what I've been saying for years now is the Fed lost all credibility as an inflation fighter based on their actions that they took in 2020 and 2021, being slow to move, to stop QE, to move rates off of zero. Clearly, inflation is not their primary concern. They were extremely dismissive of it. And here I think they're just illustrating that once again, where inflation overall, if you take an average level, any way you look at it, is not at their 2% target, and yet they're set to cut interest rates again. Do you think that's a mistake? Do you think it's going to be viewed as a policy mistake, or do you think they can explain that away, which I know they're going to do, Jamie, by saying the labor market weakness is now a bigger concern and they want to get ahead of that by cutting interest rates?
Just stepping back, these are just humans like us, trying their best. It's easy to think they have more levers to pull to foresee the future. They don't. As far as where inflation is, it's funny. I was just in a conversation with a institutional client, a government entity, and the gentleman who runs that group was asking about, what's real, what's inflation made up of? And the answer is, the manipulation that goes in these numbers that you, Charlie, and Peter have talked about through the years is extraordinary, right? What they actually factor in, what they factor out, what they think healthcare inflation is, what it really is. And so I'm not saying you can't trust the numbers, but like a lot of this, the data, good data in, good data out, it's very, very dependent. And it does, what there are elements though, yes, inflation is higher, but there is, Charlie, the jobs market, like the real wage growth has been a positive thing now, correct? Aren't we, we're
Sure.
like 26, 27 months into positive
Yeah.
real wage growth. And so it stinks that bacon prices are going up, but the average American worker can afford to buy more bacon. And so I take that as a positive thing. Yes, the
Yeah.
numbers are manipulated. The inputs that go into the actual
But
inflation readings are
Jamie, I'm going to push back there. I would view that as a reason why you need to keep fighting inflation, because the reason we got to the past 2 years of seeing real wage growth is because inflation came down. Like, without that, the reason we were doing 2 years of negative real wage growth before that is because we had the highest inflation since the early 1980s. So
That's true.
100%, that's a good sign. But you still have to answer the question: do you want a 2% target? And if is it okay to just dismiss it and say, "Hey, we're close enough. Like, let's just ease," because there's pressure from everyone to ease. Like, there's not many people like me saying hold the line, or even I think they should be hiking rates, or I think at very least they shouldn't have cut last year. Let's just say that. But I don't see many people talking like I'm talking. Right? You have pressure from the federal government. You have pressure from industry groups, housing sector. Everyone seems to want the Fed to cut interest rates here, and Powell's been resistant. I thought he would have shown a little bit more of a backbone in that last Jackson Hole meeting, saying we're data dependent. That's what I've been saying all along, and the data isn't there yet to cut. But it seems like either the pressure is just too much, or maybe they actually believe that the labor market weakness is enough to
Yeah.
justify cutting.
Well, my biggest issue with like the Jackson Hole meeting is I step back and say, why do us as taxpayers have to pay for them to have these extraordinary vacations and wonderful places where we're sitting here sweating in Kansas City in the middle of summer. Yeah, absolutely. First off, not just going with what everyone's saying is an important element in life when you believe in something, Charlie. I do see, we did have the most extraordinary exogenous shock, you know, external shock to markets that we've seen in a long, long time, maybe hundreds of years, with the pandemic that created this distortion and overall effect. That the fact that supply collapsed, right? Furniture companies had to shut down. You couldn't get parts, but you didn't have the corresponding decline in demand because, again, through these stimulus measures we talked about, those aren't supply shouldn't collapse without demand collapsing in lockstep with it. It's like when we lowered taxes at the same time we invaded, went to war. Those aren't things you're supposed to be able to do simultaneously. And so this is something that we hadn't dealt with in a long time. So it created this huge bump in the python that led to this massive bout of inflation when otherwise demographics, spending trends, the ability productivity trends were rushing us towards kind of a lower inflationary environment. So again, if it spikes back up, absolutely pause on rates, maybe raise them again. I actually see, if anything, rates are maybe slightly too high. I think it could really help small businesses and small companies struggling to get their borrowing costs down a little bit. Of course, consumers living on the edge, kind of living paycheck to paycheck, credit card spending. But I think it's this extraordinary exogenous shock with COVID that led to these conditions. And the further we move past that, I think the further it will more normalize to the long-term trends we are dealing with as a society for the trailing 20 years.
Yeah, good points. I just think that the concern about inflation is it's almost like a fake type of concern. And really, they want inflation. A lot of people want inflation because we have so much debt. And that's how you get out of that situation. You inflate your way out of it. They just don't want to come out and actually say that. And really, it's only a question of how much inflation do we tolerate? Is it 2% per year, 3%, 4%? Which numbers do you believe? But they're telling you pretty much there's going to be inflation going forward. And when in doubt, we're going to always err on the side of easing. If they cut in September, I think that's the message for market participants. AI revolution, Jamie, what inning are we in? I want to run through some charts here. NVIDIA, last major tech company to report here, and everyone's waiting for NVIDIA to disappoint in terms of not beating top line, bottom line. Didn't happen this time once again. 46.7 billion in revenue, another record, up 56% year over year. They're projecting 54 billion in revenue for Q3. Of course, that would be another record, up 54% year over year. So not a huge deceleration for Q3. Net income, here's the big one, 26 billion, another record high, up 59% year over year. And profit margins, which had declined in the last quarter, snapped right back 57%. Second highest quarter for NVIDIA on record. Here are the charts here. Vertical. We've never seen anything like this for a company this size, to say the least here. Vertical move higher in revenue. Revenue growth has slowed, but to still be running at 50%, Jamie, given the growth it had, definitely is exceeding everyone's expectation from a few years ago. Net income continuing to push higher, on pace to be pretty shortly, if they can continue to produce profits like this, on pace to be the most profitable company. Of course, it's already the largest company in terms of market cap. And here you go with the margins here, 57% net profit margins, which was unheard of for a commoditized business in the past, just showing you the pricing power that NVIDIA still has. So in terms of AI spending, Jamie, the big question is, well, what inning are we in? How long is it going to last? And if you look at NVIDIA's CEO, Jensen, and he's talking about a lot of different things, but this is the one that got a lot of attention during the call here. He's saying he anticipates the largest AI companies will spend, get this, $3 trillion to $4 trillion over the next 5 years based on their current levels of CapEx. And he's saying that NVIDIA could capture as much as 70% of that revenue. Just stunning. And there are a few analysts I saw this week that are calling for NVIDIA to grow their revenues within the next few years to 1 trillion annually. That would be the first company in history if they're able to do that. I know it's a not easy question to answer, Jamie, but you have any thoughts on where we are in terms of the AI infrastructure boom, what inning we're in?
Well, if we're talking in a couple comments here, okay, what inning are we in? We're not done stretching. The game hasn't even started yet. And you're seeing that because actually, a recent report said that the majority of AI implementations at companies are actually failing. They're not adding value. Well, that's companies just not effectively implementing. And we're doing it now to help talk to our 401k participants, provide objective advice, and there's people executing on inputting, people not. But that's why we're still stretching. We're still figuring things out. And so very, very early. But the key from an investment standpoint is this is a quantum leap forward. Just like the internet was a quantum leap forward, just like railroads were a quantum leap forward, steel was a quantum leap forward. Every single one of those quantum leaps forward had an accompanying bubble and difficult period with it. It didn't mean the internet didn't change things, didn't mean railroads didn't change things, steel didn't change things, industrial revolution didn't change things. But again, it's a natural part of the process and doesn't mean it's going to be better or worse. Not saying to run away from those investments, but not saying to just put all your eggs in that basket now, because that would be the anomaly. That would be if a bubble doesn't form associated with this great step forward, that would be the issue. And so take it back even farther, right? The NVIDIA trend line, extraordinary. I bet that trend line, Charlie, I'd love for you to try and find the statistics on this. The first caveman that figured out fire, I bet the trend line on that caveman's revenue stream versus others just took off at a similar trajectory. And so the idea is, yes, it is this brave new world, and they are at the epicenter of that. But really, NVIDIA, it'll hopefully move forward. It'll continue to be a great element, but it's in elements it's priced to perfection. But what it's helping generate might help a ton of other companies in the economy, ton of other companies within your investment portfolio benefit from. And for here, as far as the spending, how we're looking at it, first off, that's a great way about broad, tax efficient, diversified, cost efficient, index investing. You get to participate in these growth trends, but you're not beholden to it, right? What's big tech today was big oil at one point, big, box stores at one point before that. So you can participate, but you're not permanently beholden to it. But an element that we, beyond that, are utilizing a lot of our client portfolios, if it makes sense, is infrastructure as an investment. First off, we like it more just because it responds to market conditions differently. But there's a tremendous amount of infrastructure spending that's actually kind of has bipartisan support that's needed to keep up with the demands of artificial intelligence. But that's just the new economy stuff. Infrastructure also includes investing in companies that build the roads, build the bridges, maintain the roads and bridges, recycling centers, the stuff they call critical infrastructure for a reason. And so that's how we're actually attacking it from a portfolio allocation standpoint, participating with it with infrastructure, with its element in the indexes, but knowing the fact that it makes sense. It is something that's probably going to have that quantum leap forward, but it would be the abnormality if at some point there wasn't a tremendous amount of volatility associated with this step forward.
Yeah, so that's the big question: is what interrupts it? Like, this is all assuming status quo, right? If companies are benefiting from it and you're seeing productivity gains, and they're going to keep spending, right? And obviously, the biggest players, Microsoft, Amazon, Google, Meta, they have so much free cash flow, Jamie, and they're viewing this as we're viewing it as the technology that's going to drive the next 20 years, maybe even more. They can't afford not to make this bet. I guess the question would be, for the smaller companies, for the average company, are they going to start seeing the benefits of this as well? Or are we going to see spending there? Like, most of this NVIDIA, in terms of their revenues, they're talking about, is concentrated in a very few small number of companies that obviously can afford to pay up for this level of technology. But I guess the assumption would be it's going to become more efficient. It will become cheaper at some point over time. Just hasn't happened yet. So that's a long-winded question. But I guess the biggest question is, what's going to disrupt it? Is it exogenous event that we're not anticipating? Is it an economic slowdown that causes these big companies to get more hesitant to continue this expansion, or is it something we're just not talking about altogether?
It could be something. It could be any one of those things. It could be something we're not talking about because no one knows what it could be. Irrational exuberance, a broader slowdown. A whole host of potential issues. But to your point, we really see, or at least I really see, it actually expanding out the winners of this evolutionary step forward. In that, right now companies aren't effectively harnessing it, but the idea, as that application continues to be more and more effective, again, your standard company helping from an accounting methodology standpoint, helping from an insurance analysis standpoint, just any standard company that's business is not semiconductors, a business isn't technology, but harnessing this to create greater productivity, greater earnings for their shareholders. I think that will hopefully start to manifest itself. So it won't, the true benefits won't be so concentrated in such a small subset of stocks.
That'll be interesting to see, because of course we know the large caps versus small caps just dominant over the last decade, and small caps, not like they're not higher, they've definitely participated in the bull market, just have lagged. And I guess if you could make a case that they're going to be able to grow their earnings and increase their margins because of this technology, maybe that's underappreciated given their valuation. But that's a topic for another day. I just want to touch here on, Jamie, NVIDIA, where it is in terms of the S&P weighting versus its underlying fundamentals. And this is something I update every quarter, but we're at 8% in terms of the S&P. So if you own the S&P, 8% of that is in one stock, NVIDIA. That's the most of any stock, single stock, going back to 1980. It's even more than Apple's record weight last year. And so always the question, Jamie, is, well, what is NVIDIA's weight in terms of net income? And both of these numbers continue to grow. So we're seeing NVIDIA's dominance in terms of the index grow and its net income grow. There's still a gap here of close to 4% between the two, but really that's the expectation from investors saying that profits are going to increase substantially going forward. It's almost already the top company in terms of net income, and if it continues at this pace, it won't be very long before that's the case. Do you think investors are overly optimistic in making that bet, or do you think that's a reasonable bet given what Jensen's talking about here, 3 to 4 trillion in terms of potential spend by the biggest players over the next 5 years?
I mean, the historical data would say they're probably overly optimistic after the tremendous run this innovation has already had in the markets. Again, it might start to regress tomorrow. It might take another 20 years. But another thing that's actually benefited investors over the long run is allowing the trend to be your friend, right? And this is why if you're investing, putting your eggs in the NVIDIA basket, it's great that it's worked out. We're actually helping, hundreds of clients actually exit that concentration in a tax neutral manner right now. They're spending a lot of money on it. It's great. We're not saying it might not keep moving forward, but it could be like Cisco where it's still 50, 60, 70% below its all-time high when the markets are 500% higher. So probably the dad would say, when something's when some expansions had this tremendous run, you're putting too many of your eggs in too few baskets. But that's the idea of not being beholden to the individual company. And what's interesting here, Charlie, talks about, yes, the concentration in the S&P 500, but circling back to my non-uniquely American phenomena, isn't it the domination of the Mag 7 or like the top 10 names? Isn't the United States still, even that's growth, it's one of the least concentrated stock markets in the world. A lot of other economies, they're far more dependent on 1, 2, 3 dominant names that make up their index. And so it's interesting. People think of this as a uniquely American phenomena. I see it more, or I'd love your opinion on seeing it more as just a uniquely American phenomenon, just because the size and strength of the American economy based on these other market players.
Yeah, it's just relative to our history. You're correct. We showed that chart a few years ago when you and I were doing an episode together, and yeah, the U.S. I think Japan was the only country with a less concentrated market than the U.S. Now at that point, Jamie, it was the Mag 7 was about 20%. Now it's over a third of the index, so definitely looking more like the rest of the world, but certainly it's not uncommon to see this. I think what's just so startling is not just the representation, but like the pure dominance in our everyday life that Google, Apple, Microsoft, Amazon have in terms of these are the products we use every single day to varying degrees. And they've just persisted, right? They've just shown the ability to outgrow everyone else. And that's why they continue to trade at premium multiples, and that's why their weight continues to outpace what they're actually producing right today in terms of net income. So that'll be the question. It was the same question back in 2000, Jamie. The gap was much wider then between the tech's weight and what it was producing in terms of net income. It's much wider than today. So definitely today is more fundamental driven, but there's still an expectations gap. There's still a belief for good reason, by the way, right? These companies are producing it. They all have above average profit margins, right? Versus the average company. They're all growing faster than the average company. So it would be unreasonable for investors not to expect that to continue. But still is that gap. You can't make the case that investors aren't making that bet. But final thought in terms of innings, right? So I think I view it two different ways in terms of what inning are we in. One is like AI in terms of its impact, in terms of how you're using it. I know you're a Luddite, but at some point, Jamie's going to be using AI technology. It's going to be, you're very efficient, Jamie. So I'm not going to say that it can increase your efficiency very much, but you're going to be using it. You just don't know how yet. And I think that's the case for a lot of people. And we're just scratching the surface in terms of that part. But the other part, I would say, in terms of is it early innings, in terms of the market's exuberance over this, it would be hard to make that case given just looking at valuations. The Shiller PE, the CAPE ratio hit 39 this week, only crossed above 39 for the second time in history. The other period was in the late 90s. Now, of course, back then, Jamie, it went up all the way, almost hit 45 right back then. So could this go higher? For sure, it could go higher. And if you're arguing that AI is going to be a more revolutionary technology than even the internet, then maybe it goes to 50 or even higher than that. Well, there's no upper limit in terms of valuation. But when I look at a chart like this, it's hard for me to say we're in inning one or two in terms of the market cycles appreciation for this technology. But maybe, as you said earlier, it has to end in just like the biggest bubble of all time, just given how revolutionary it is.
I think the biggest bubble, again, back to my caveman with fire, the first caveman who got a little bit too close to that fire with all their beard and scruffy stuff, that probably, that bubble bursting was, I think, a lot more painful when you think about it, Charlie, than this. But it's a natural progression. It happens with markets, just like the volatility we saw. Again, don't be dependent on it, participate in it, diversify, and just like the challenges of 2000s with internet, something like that could manifest itself again. It didn't mean it didn't change everything, make us more productive, and make people's portfolios go up in value by hundreds of percent.
Yeah. So I think that's another way of saying, is it possible to say what inning we're in until the game is over? And the game is really never over. It's always continuing. There's no end to it, but we'll only be able to say years from now where we were in this cycle. All right, let's go on very quickly here. I want to touch on this idea of a tariff rebate is a good idea. U.S. custom duties, Jamie, 28 billion in July, expected to hit 30 plus billion in August. We're not going to debate whether this is good or bad. That would be too long of a topic. But 4x increase over the last year in terms of what we're bringing in terms of tariff revenue. So as you might expect, some people are now suggesting, including the president, maybe we should send that money out, some of that money at least, in terms of a stimulus. As President Trump said this week, we have a lot of money coming in. There's a concept of making a dividend to the people of this country who have paid a lot in taxes and got nothing for it. What do you think about a tariff rebate or stimulus at this point?
I neither like tariffs nor rebates. I don't like other countries, having a non-fair playing field, so it can be as most efficient as possible. Per se, tariff is just a synonym for tax, right? Companies are now just absorbing the most of it, so it's working. But again, the idea that, and then rebate, I don't like either. So you combine them together, it's even worse. I love my father-in-law, wonderful guy, very much on top of it. He loves a good rebate, like when you go to get new tires, and all you have to do is mail in this rebate or fill something out. Well, part of it is it's just inefficient because again, he does it. He's great. He's on top of it. I get back in the car. There's 3 kids in there, right? And they have 3 different events in 3 different parts of the city at the same time. You get busy. It doesn't work. It's inefficient. And so the idea of a rebate system, even if it's optimized, it seems like you're creating unnecessary friction costs along the way. So not a big believer in either elements of that equation, and I think it actually gets even worse when you combine the two.
Yeah, it's kind of interesting to frame it that way because if you're saying ultimately that the consumer is going to be paying for this, they're essentially paying a tax and then getting the money back on that tax. If that's your belief, that's what most economists are arguing. Remains to be seen. I think it's going to be some part taken by the seller overseas, some part by the U.S. corporation, and then with the passage of time, and we're not seeing it yet because there was a massive pull forward in terms of what we were importing before the tariffs were put in place. But when those inventories are replenished, you're going to see more companies trying to pass it on to the consumer. But in terms of should we be sending money to the American people like stimulus again, I would argue very much no, because what we're doing, all money is fungible. So that tariff revenue that's coming in now, originally they were saying it's going to be used to try to eliminate the debt or reduce the deficit. And if we can do 30 billion a month, Jamie, that's a decent amount of revenue coming in, assuming right nothing else changes, obviously in terms of growth. And you could use that theoretically to pay down part or reduce part of this $2 trillion deficit. If you don't do that, that when you're essentially doing is continuing to borrow money and just taking some of that borrowed money and sending it out to people, which of course we know from recent history would be inflationary. So people are going to see higher prices from this tariff situation. Then they're going to get this rebate because you know, they're saying we have all this money coming in. We got to send some of it out, but you're still borrowing net. So that policy to me should be inflationary, and that's just going to help drive this national debt up even faster. We just recently passed 37 trillion. The debt ceiling, as you know, was lifted under the big beautiful bill, raised by 5 trillion, which to me was an acknowledgement that they're likely going to hit that in the next few years. And so to me, tariff rebate, whatever you want to call it, it's really just borrowing money once again and sending it out, which I have no doubt, Jamie, would be very popular. And that's why they're proposing it.
I wouldn't rip it up when I pulled it out of my mailbox, but doesn't mean it's not inappropriate. We tell it all the time to our clients, especially let's say our institutional clients, maybe on the 401k side, that you can't grow your way out of a savings problem. And so the idea, if your fiscal house is not in order, again, this is something that would have had me or you thrown in debtor's prison a long, long time ago, Charlie. Right? Again, the unique levers that the United States can pull allows us going, but it's not solving for the core issue, right? Stimulus. You're an immediate opiate instead of curing what the ills are. That's the issue we're at now, and until we can really kind of start to focus on getting that in order. And again, it's a larger issue, right? Not the periphery stuff that Elon Musk was taking a stab at for a while. Kind of some of these core issues that neither sides of the political aisle are willing to deal with. Until you really start to focus on those, again, really nothing else matters. It's window dressing and it's headlines, but nothing but noise.
All right. Well put. We'll see what happens there. Number 5 here, is AI coming for our jobs? This is a survey you sent me, Jamie. Over 4,000 U.S. adults asking about concerns about AI. And what I really want to highlight here is number 2, too many people will lose their jobs. 71% of people concerned about that. There's obviously other concerns as well. But to me, that seems front and center in terms of what people are worried about as it pertains to AI. And I would say, Jamie, it's not a totally irrational concern. I don't think we should just outright dismiss it, particularly with the data we're starting to see in terms of new hiring for recent graduates. And if anyone knows a recent college graduate, or if you're talking to someone, seems to be much harder to get that entry level job. Here's a chart showing the unemployment rate for 20 to 24-year-old recent graduates here, and it hit 8.1% in July. Of course, that's a big deviation from the overall unemployment rate, which is around 4.2%. Are you hearing something around this, Jamie? And do you think, even if long-term AI is a great force for humankind and it helps productivity and helps profits and all the rest of it, that there's a case to be made that some of these fears in terms of people losing jobs or jobs being harder to come by, do you think that's going to materialize, or perhaps is already materializing?
Well, it would be, a bubble not forming with a step forward. That would be the anomaly, right? Not having a 14% decline any given year in the markets on average, that would be the anomaly. People fearing these moves forward, taking jobs. If that wasn't the case, that would be the anomaly. A lot of great data, again, through time, the idea of the industrial revolution, which I would actually put AI on it as the biggest element since then. I mean, think about it. Really, for 1,000 years, 2,000 years, not much had changed besides like clothing styles, as far as how people like tended to the fields and produced goods, right? Small, very small, but nothing changed. And then obviously when the Industrial Revolution occurred, people were saying, hey, this is going to take away all these jobs. And it did. But it didn't take away jobs. It actually made dramatically more of them. I mean, that's been the case since history. Who knows? Maybe this is different. But again, history doesn't repeat itself, but it oftentimes rhymes. And so that being the concern, or people's perception of a concern, that makes complete sense to me. Using history as our guide, as far as, yes, seeing this as well, you are seeing this interesting dynamic. Actually, a young gentleman who recently joined us said, we were talking about this. He said, "Well, if you used AI to inflate your grades in college, shouldn't you expect maybe that it's going to have a possibly negative reversion to the mean consequence on the back end?" And he was, I thought that was pretty good. And so the idea is, yes, this is a concern, because what are a lot of these jobs? What are the jobs I had as a 22-year-old? I had no idea how to do anything. And I learned it by doing grunt work, really, by digging around, by doing the things that others didn't want to do. And so the dynamic of the stuff that I did as a 22-year-old, yeah, if AI can take care of a lot of that, it will create a momentary challenge. But as humans, we're extraordinarily adaptable, and what we're going to fill the coffers with young people, it will be. We'll figure it out. Again, instantly, the spikes before, when I came out of college, when I came out of graduate school, were even higher than this. You find a way, and markets find a way, and the evolutionary process of humans not fearing, not losing out to technology, but embracing it to make things better for all of us is what the historical trend tells us. And I think we'll figure it out there. But just like, hey, if you got your master's degree in horse buggy engineering in 1910, you were probably in a bad spot come around 1925, when Ford really has that thing streamlined. So you have to change. There's going to be losers in the process, a transitionary process, but hopefully it'll put people in younger workers in a better position than I was in when I was stapling papers. I was
I'm
changing.
sure you were the best stapler in town, though, Jamie.
Yeah, and so, but yeah, it's a transition, but hopefully, the human ingenuity and the skill set will transition as well to harness it effectively.
Yeah, well said. It's hard to predict. It's hard to advise people if someone was just heading off to college now, Jamie. What would you tell them to focus on, other than saying to be adaptable and try to develop skills that will help you in the real world? I think there's going to be a renewed focus on that in terms of the old traditional liberal arts type of major that had little to do with what you were going to do in terms of your job. I think people, especially given the cost of tuition continuing to rise and student loan debt being still a big issue for people, there's going to be a much bigger focus on the next few years, given these types of pressures, and especially if they increase on, well, what can I actually bring to the
Yeah,
table off the bat? And that'll probably be different than what it is right now.
very much so. And yes, what I would advise, first off, college inflation rates are about as crazy to me as the fact that politicians can legally trade stocks on insider information in some capacities. Who thinks that's a bad thing? Who thinks that should be how it is? No one, except a few people benefiting from it. But the idea is, first off, what would you do? I guess circling back, first off, I'd say please don't do what I did, Heavenly, right? But the idea is, um, more so find what you love and latch onto it, right? And I actually kind of learned what I wanted to do and what I loved and what I was good, almost by learning what I didn't love and what I didn't want to do and what I wasn't good at. So I think it's more important to try and harness and focus on something that you're passionate about. Passion leads to productivity and putting yourself in a position to continue to add value and excel. But I think just the arbitrariness of just going to college to just go because it's a societal norm and you exit with nothing but bad habits, um, you know, uh, you know, baggy eyes and a massive amount of student debt. And now you don't have the ability to just take that in neck crunch up. Yeah, it will hopefully recalibrate some of those decisions. But yeah, it's a pivot. That's why we're not even in the first inning of this adjustment, Charlie. We're still stretching. We're
Yeah.
stretching as a society to figure out how to do it.
And we're just talking about recent graduates, but of course, no one's immune to this, even in your established careers. It's going to impact everyone. You just look at what it could do in terms of law, in terms of contracts, and reviewing documents and analyzing things, and what it could do for taxes in terms of making recommendations and just immediate. It's just surprising to me, Jamie, how quickly over the past year I've noticed, just using it more and more, how quickly it could come up with an idea that's pretty good in terms of scanning 1,000-page document and summarizing it, and how quickly, if you tell it no, that's wrong, how quickly it admits it's wrong, learns from it, and will then give you the right answer, right? So it's not perfect right now, but it's getting better so rapidly. It's hard to even project what it's going to be able to do a year from now.
Yeah, like so much stuff in life, right? It's a great servant, but a horrible master. And use it appropriately and moving along with it, but don't let it eliminate your ability to critically think. That's a wonderful element of the human body, and allowing something else. That's the unique thing now versus all these other things I talked about. It essentially unshackled our bodies to allow us our minds to sharpen. Right, you're not as much time in the fields. Even internet, you opened up an entire world, and so that's a unique thing. Is that again harnessed effectively? It's wonderful. Eliminate the document review, insurance mistakes, whatever. But if it eliminates your ability or desire to think and learn and evolve, that that's actually a you problem, not the technology problem, in my opinion.
Yeah, good point. Good point. Okay, let's end as we always do with something positive here. Maybe AI is going to help accelerate this, Jamie. We're working less than ever before, but we have more prosperity than ever before. This is a chart, annual working hours per worker going back to 1870, so last 150 years here. And what we're looking at is the hours average used to be around 3,000 hours working per year, and now we're about half that, 1,500. It's showing various developed countries around the world all experiencing the same trend. So if you just looked at this at nothing else, you might say, gosh, we're working much less. Well, we must be producing less. We must be in a worse position. Of course, we know that's not actually the case. We were more productive than ever, just looking at, and wealthier than ever, just looking at GDP per capita. Of course, the US near the top with other Western countries there and Western Europe. But everyone has benefited from this trend, Jamie. It's an up and to the right trend. So technology, human ingenuity, innovation has really lifted the entire world higher. And it's actually, and this is one of my favorite charts, reduced the level of extreme poverty to less than 10%, when 150 years ago it was about 3 out of every 4 people.
Yeah, I mean, this is the greatest thing we went over today, and that so many people just the most almost inconceivable for people lucky like me and you, Charlie, to realize that the type of suffering that just day to day life was, how that percentage of people dealing with that is going down. I mean, obviously there's lots of concerns with China, geopolitical back and forth, but really the most amazing thing, the most amazing economic miracle of the last 40 years or so was the Chinese, ripping over 1 billion people out of object poverty and putting them squarely in the global middle class. We can agree with their policies. We cannot. I do not agree with communism as a policy. It seems to fail 100% of the time over a long enough time horizon. But the fact is, human beings are not starving to death. And again, what is that coming through? That's coming through productivity enhancements, agriculture enhancements, which are just productivity enhancements. And that's what harnessing technology. Back to my terrible caveman with fire analogy, right? He starts cooking up that saber tooth tiger meat. He's probably not. He's living a longer life than his caveman neighbors, and that's all from productivity enhancements and the fact that it's helping human beings not suffer as much as they were. that's a wonderful thing. I don't see what can be more wonderful than that.
Absolutely. I can't think of a better way to end the show than that, Jamie. Thanks everyone for joining us on this edition of Week in Charts. Have a great Labor Day weekend, everyone. Enjoy the weather, enjoy the barbecues, get outside, and we'll see you next time on the next episode of the Week in Charts. Thank you very much, Jamie, for joining us.
Yeah, thanks, Charlie, for having me, Mike.